Hello students, I'm back, and in this session we will be learning how to record credit sales. So in the previous session we learned how to record cash sales, and we know that inventory is sold via cash transaction or a credit transaction. So this session we will focus on credit transaction. How do we record a credit sale? Now, when we talk about credit transaction, we must think of the account trade receivables. All right, why trade receivables? Trade receivables are what your customer owes you. All right, what your customer owes you. Owes you. Okay, so let's remember when there is a credit transaction, the account affected is trade receivables, and trade receivables are what your customer owes you. So again, let's recall that when there is a sale of inventory, we always have to remember that there's a cost of inventory affected and a selling price of inventory affected. Remember, right? We said the cost of inventory left, all right, these $7 left together with the company, the customer. But at the same time, what comes in is that $55. All right, that $55 income comes into my business, right? So we have to record these two transactions separately. So actually, when it comes to recording the transaction, there is no change in the accounts. All the accounts are the same. The only difference in the accounts is this one, the one with the big fat star. All right. Instead of recording cash in hand and cash at bank increase, we will record it as a we will record a trade receivables increase. This is the only new thing. Everything else is the same as the previous section. So how can I record this transaction? So in this case, business sold inventory to Max costing $500 for $700 on credit. All right, but again, let's not just think about this. There's actually two things that's happening here, right? You have to record the cost, leave with the customer. Phew, fly away. Oops. The cost leaving with the customer. And then the selling price of the company. All right. So what we're going to do is we're going to look at the selling price first. $700 on credit. Okay. And how should we record this transaction? Now we know that when you sell your inventory, right, you will get an income. And we know from the previous section that when there's an increase of income, your equity also increases. Right? So you will have sales revenue plus $700. But how am I going to record this on credit? Now your customer owes you money and has not paid you yet. When your customer owe you money and haven't paid you yet, that is a trade receivables. Trade receivables are part of assets. And your customer owe you more money, so your assets increase. So we will record trade receivable hyphen max because you know who your customer is and plus 700. All right. So this portion here is really the new thing for this session. Because of this on credit, you will record a trade receivable max. All right. The other section, which is the cost of sales over here, is not going to be very different. All right, so we are going to record the cost of sales now. When you have a cost of sale, this $500 left the business, you will record inventory minus 500 because the inventory left with the customer. The other account affected is cost of sales increase. But although cost of sales increase, you need to remember that equity went down. Equity went down. And if you cannot remember why equity went down, please go back to the previous section and review why equity went down. All right, so when there is a credit sale of inventory, when you have sold something and you haven't received the money from your customer, this is what it looks like. Again, I want to remind you that these two accounts, inventory and cost of sales, are paired together, and these two, trade receivable and sales revenue, is paired together. Okay, they are good friends. They come together. That's why the color different. All right. Now, what about the accounting equation? How is this reflected on the accounting equation? Let's take a quick check. So, firstly, when you have trade receivable plus 700 and inventory minus 500, your assets actually increase. All right, your asset actually increased by $200. Asset increased by $200. And on the other hand, when your sales revenue increased by 700 and your cost of sales reduced by 700, or rather your equity reduced by 700, overall your equity will increase by 200. So asset plus 200 equals to equity plus 200. Your accounting equation is balanced. Take some time to think about it and see whether you understand. And if you do understand this, you can go on and try the next activity on SLS.